Benjamin Graham opens Chapter 2 with a blunt point. Inflation matters, and it changes the way you should think about investments. People with fixed dollar incomes, pensions, bond coupons, savings, get hurt when prices rise. Stocks, on the face of it, offer protection because companies can raise prices, and dividends and share values can rise too. That's the simple story. But Graham's whole argument is, the simple story is not the whole truth. History shows inflation is nothing new. In some 5-year spans, prices nearly doubled, think 1915 to 1920, and in others, prices barely moved. The late 1960s gave a wake-up call. Between 1965 and 1970, prices rose materially. Graham reports about a 15% 5-year rise. And between 1966 and 1970, there was about a 22% cost of living increase. So, inflation can persist. But how fast will it go from here? Graham says we can't know. He suggests using a reasonable planning assumption, maybe 3% a year, and thinking in real terms, not just nominal returns. That brings us to the stock versus bond question. Over the long sweep, Graham looks 55 years from 1915 to 1970. Stocks have outperformed bonds. The Dow Jones Industrial Average rose from an average of 77 to about 753 and paid dividends that added materially to total return. But here's the kicker. Past outperformance isn't a promise. At the prices of the early 1970s, Graham calculates that expected future returns from typical stocks weren't likely to exceed maybe 8% a year in total, roughly 3.5% in dividends, plus 4% or so in growth from reinvested profits. That wasn't clearly better than what high-grade bonds were offering at that moment. In plain language, buying stocks because they always beat inflation is sloppy thinking. Why? Because corporate earnings and prices don't move in lockstep with inflation. Graham shows that earnings per share haven't reliably risen just because wholesale prices rose. A lot of past earnings gains came from reinvested profits and expanding capital, not from inflation magically lifting returns on old capital. Other forces, rising wages, heavier capital requirements, and a big increase in corporate debt offset price gains. For example, corporate debt ballooned between 1950 and 1969 while profits didn't keep pace. Interest burdens became a real drag on firms. Utilities, often seen as victims of inflation, may actually be structurally protected because regulators allow them to raise rates to earn a fair return. Because markets swing, Graham insists we think in two time frames, the long run and the short or intermediate run. Stocks might be fine over 25 years, but in stretches of 5 years or less, they can be miserable. The recovery from big crashes can take decades. General Electric and the Dow Jones Industrial Average took 25 years to regain ground after 1929. So an all-stock bet, made because you're worried about inflation, can leave you exposed to terrible sequences of returns. What about alternative hedges? Graham is skeptical of easy answers. Gold, often touted as inflation insurance, rose only modestly from $35 to $48 an ounce over several decades, and it pays no income and costs storage. Collectibles sometimes skyrocket in price, but they're illiquid, subjective, and risky. Direct real estate can protect against inflation but is volatile, illiquid, and often impractical for ordinary investors. Graham's practical conclusion: don't abandon bonds or cash completely, and don't assume stocks are a guaranteed inflation shield. The modern commentary adds two useful tools Graham didn't have back then: REITs and TIPS. REITs let you get broad real estate exposure without buying individual properties, and they tend to hold up reasonably well when prices rise. TIPS, Treasury inflation-protected securities, adjust principal for inflation and are backed by the government, making them a very direct hedge for purchasing power. These are best held in tax-deferred accounts to avoid odd tax quirks. These are sensible ways to diversify an inflation defense. So what should an intelligent investor do? Graham's core advice is conservative and sensible. Diversify, match your strategy to your temperament, and don't throw everything into one belief about the future. If you rely on your portfolio for income, be particularly cautious. Keep a meaningful stock allocation for long-term growth, but retain a bond component as insurance. Consider a slice of real estate assets or inflation-protected securities for explicit coverage. And always judge returns in real terms after inflation, not by the flashy nominal numbers. In short, inflation is real and worth planning for, but it's not a reason to abandon discipline. Expect fluctuations. Plan for uncertainty. Protect purchasing power with a mix of assets, and don't confuse a loud argument about inflation with a foolproof investment strategy.